What if I told you that for decades, silver has been quietly doing something unusual every single week, and most investors have no idea it's happening? Not gold, not stocks, silver, and it happens specifically on Fridays. Stick with me for the next few minutes, because by the end of this video, you're going to see the precious metals market in a completely different way. And it might just change how you think about your next trade. Let's start with the basics, because before we talk about patterns, we need to talk about why silver behaves differently from almost every other asset in the market. Silver is a strange beast. It's not just a precious metal, it's also an industrial metal. About 50 to 60% of all silver demand every single year comes from industries. We're talking solar panels, electronics, electric vehicles, medical equipment. That means silver is constantly being pulled in two directions at once. When the economy is booming, industries want silver. When fear hits the market, investors want silver as a safe haven. That dual identity is exactly why silver can be so volatile, and it's also why it can create these repeating behavioral patterns that, once you see them, you simply cannot unsee. Now, here's where it gets interesting. Traders and researchers who track precious metals have noticed something over the years. Silver tends to show distinct price behavior around Fridays. This isn't some internet rumor or a random chart observation from one guy with a laptop. There's actually academic and institutional interest in day-of-the-week effects in commodity markets, and silver consistently comes up in those discussions. So what exactly is the Friday silver pattern, and why does it exist? To understand this, you have to think like a market maker, not like a retail investor. Big institutions, hedge funds, commodity trading firms, they operate on weekly cycles. Every Friday, they're looking at their books. They're assessing risk going into the weekend. And here's the thing. Over the weekend, markets are closed, but the world doesn't stop. Geopolitical events happen. Economic data gets released. Things change. So smart money does not want to be sitting on large, unhedged silver positions going into a Saturday and Sunday when they can't react. That creates a very predictable pressure on silver prices late in the trading week. What researchers and traders have observed is that silver often experiences selling pressure on Fridays, particularly in the afternoon session, as institutional players reduce their exposure before the market closes. Then, as the new week opens, especially on Sunday night when futures markets reopen, and through Monday, silver can see a rebound as those same players re-enter their positions. That weekly rhythm, that ebb and flow driven by institutional risk management, is at the heart of what people call the Friday silver pattern. Now I want to be really clear here because this is important. This is not a guaranteed money printer. No pattern in any market is. What this is a tendency, a statistical lean that has shown up consistently enough across enough years of data that it deserves serious attention from anyone who trades or invests in silver. The pattern is more visible in certain market conditions than others. During periods of high volatility, high geopolitical tension, or when major economic data is expected, the pattern can get disrupted entirely. Understanding when the pattern holds and when it breaks is actually just as valuable as knowing the pattern exists in the first place. Let's talk about the mechanics a little deeper, because this is where it gets really fascinating. The silver market is unique in that it's relatively thin compared to gold or major currency pairs. What that means is that large orders move the price more dramatically. So when institutions are trimming positions on a Friday, even moderate selling can push silver down noticeably. And when they come back in on Monday or Tuesday, even moderate buying can push it back up. That thin market liquidity amplifies the pattern and makes it more visible to anyone who knows where to look. There's also a psychological element here that you shouldn't ignore. Retail traders watch institutional behavior when they see silver dipping on a Friday afternoon. Some of them panic and sell too, which adds fuel to the downward pressure. Then when silver starts recovering early in the next week, those same retail traders pile back in, adding to the upward pressure. So the pattern feeds itself. Institutional behavior triggers retail behavior, which amplifies the institutional effect, which creates a cleaner, more consistent signal. That feedback loop is one of the reasons this pattern has persisted for as long as it has. Now, if you've been enjoying this breakdown so far, go ahead and hit that like button and subscribe to the channel right now. We break down real market patterns, investment strategies, and financial insights just like this every single week, and you don't want to miss what's coming up. Let's talk about how real investors and traders have used this knowledge. Some short-term silver traders use the Friday afternoon weakness as a potential entry point, meaning they look for silver to dip late on Fridays and consider buying into that dip, expecting a recovery early the following week. This approach is sometimes called a weekend dip buy strategy in commodities trading. Others use it the opposite way. If they're already holding silver and they see Friday afternoon strength instead of weakness, they treat that as a warning signal that something unusual is happening, maybe a major news event or a shift in the macro environment, and they stay cautious. Long-term silver investors also pay attention to this pattern, but in a different way. For them, it's not about trading in and out every week. It's about timing. If you're planning to add to your silver position anyway, whether through physical silver, ETFs like SLV, or silver futures, knowing that Fridays historically represent lower pressure buying windows can help you get a slightly better entry price over time. Across months and years of accumulating silver, those small timing advantages add up to real money. But here's what separates smart investors from everyone else. They don't just know about a pattern, they understand its limits. The Friday silver pattern has historically been weaker or even reversed in a few specific situations. The first is when a major Federal Reserve announcement or interest rate decision falls on a Friday. In that case, macro forces completely dominate, and the normal weekly rhythm gets buried under the noise of central bank policy. The second is during geopolitical shocks. When something like a major conflict escalates or a financial crisis hits, silver's safe haven demand kicks in hard, and it can rally strongly on any day of the week regardless of normal patterns. The third is during times of extreme dollar weakness because silver is priced in dollars, and when the dollar is falling fast, silver prices tend to rise mechanically, overpowering any day of week tendency. Knowing these exceptions is not a reason to dismiss the pattern. It's actually a reason to trust it more on the days when none of those disrupting factors are present. A professional trader looks at the calendar on Thursday evening and asks, is there a Fed meeting tomorrow? Is there a major jobs report? Is there any geopolitical situation escalating? If the answer to all of those is no, then the Friday silver pattern is more likely to play out as expected. That's how you use patterns intelligently, not blindly, but contextually. Let me give you a real-world framing here. Imagine silver is trading at, let's say, $30 an ounce on a Thursday. Nothing major is happening in the macro environment. Friday comes around, and in the afternoon, silver dips down to $29.40 or $29.50. That's about a 0.5% to 2% dip, which is perfectly normal for silver given its volatility. A trader who knows the Friday pattern sees that dip not as a reason to panic, but as a potential opportunity. They buy. The weekend passes. Monday morning institutions come back in. Silver recovers to $30.10 or $30.20. That's a clean, small gain in 48 to 72 hours, driven entirely by a predictable behavioral pattern in the market. Now multiply that by a dozen trades over a quarter, and you start to see why serious silver traders care deeply about this kind of edge. And here's something that most people don't talk about. The Friday silver pattern also has implications for options traders. If you trade silver options, the expected Friday dip can affect how you price short-term puts and calls. Traders who understand this pattern can sometimes find that short-dated call options bought on Friday afternoons are mispriced relative to the expected Monday recovery. That's a more advanced play, but it shows you just how far the ripple effects of this one behavioral pattern can extend through the silver market ecosystem. Now let's zoom out and talk about the bigger picture, because silver in 2025 and beyond is entering a fascinating macro environment. Industrial demand for silver is absolutely exploding, driven by the global push towards solar energy and electric vehicles. At the same time, investment demand is surging as investors look for alternatives to gold, which has become extremely expensive. When you combine surging fundamental demand with a market that already has these built-in behavioral patterns, the result is an asset that serious investors and traders absolutely need to have on their radar. The silver market is also increasingly influenced by retail investors. The Reddit era crowd proved that with the GameStop saga, and there was a similar moment in early 2021 when retail traders tried to squeeze silver. While that specific squeeze didn't hold, it showed the world that silver is now on the radar of millions of small investors who didn't care about precious metals 5 years ago. That new pool of retail participants actually strengthens behavioral patterns like the Friday effect, because retail traders are even more likely to have emotional, schedule-driven trading behavior than the institutions we talked about earlier. Here's the bottom line on everything we've covered. Silver is not just a shiny metal you buy and forget about. It's a dynamic, complex market with real, identifiable behavioral patterns that repeat week after week, year after year. The Friday silver pattern is one of the most discussed and studied of these patterns. It exists because of how institutions manage risk going into the weekend. It gets amplified by retail trader behavior. It's strongest when macro conditions are calm, and weakest when major disruptive events are happening. And it creates genuine, usable opportunities for investors who take the time to understand it. Whether you're a short-term trader looking for weekly edges, a long-term accumulator trying to optimize your entry timing, or an options trader hunting for pricing inefficiencies, the Friday silver pattern is a tool worth adding to your market intelligence toolkit. The investors who consistently outperform don't just know what to buy, they know when to buy it, and understanding market patterns is a huge part of that timing game. If this video gave you a new perspective on silver investing, or if there's a specific market pattern you want us to break down next, drop it in the comments below. We read every single one, and your suggestions actually shape what we cover next. And if you know someone who trades silver or is thinking about getting into precious metals investing, share this video with them right now, because this is exactly the kind of information that doesn't get talked about enough. It takes about 2 seconds to share, and it could genuinely help them make better investment decisions. We'll see you in the next one.